Imagine you've hit a financial rough patch so deep that bankruptcy seems like your only way out. You're not alone. Millions of people file for bankruptcy in the United States each year. But what does it really do to your money and life? Today, we're breaking down the cold, hard facts about how bankruptcy impacts your finances. Bankruptcy basics. When you declare bankruptcy, it's like hitting a financial reset button in terms of your debt obligations. It's an official legal process through which individuals can either eliminate their debts, Chapter 7, or reorganize them into a manageable repayment plan over time, Chapter 13. Chapter 7, this is the most common type. You liquidate assets, sell off what you own, excluding exempt assets like basic household items and tools to pay creditors as much as possible, then start fresh. Chapter 13, here you keep your stuff but work out a plan to repay some of your debts over 3 to 5 years, based on your ability to pay. Filing for either Chapter 7 or Chapter 13 bankruptcy has long-term consequences and requires careful consideration before proceeding. However, how does it impact your daily financial situation? Immediate impact when you file for bankruptcy. Credit score drop. Your credit score typically decreases significantly upon bankruptcy filing, often by 100 points or more initially. Debt discharge. Most unsecured debts such as credit cards and medical bills are eliminated through bankruptcy. However, secured debts like car loans and mortgages may still require ongoing payments to avoid losing the collateral. Asset freeze. You generally cannot sell major assets without court approval once you file for bankruptcy. This prevents liquidation of assets before filing to unfairly benefit some creditors over others. Imagine your finances as a house. When bankruptcy occurs, it's like someone temporarily sealing off all the exits to prevent you from moving assets around, ensuring everything is accounted for during the legal proceedings. This period can feel restrictive, but it also offers protection by halting creditor actions and allowing time to reorganize financial affairs under court supervision. Long-term impact after bankruptcy. The initial shock may fade over time, but the long-term effects can persist for several years. Credit score recovery. Your score will start improving as you establish new lines of credit, but it typically takes 7 to 10 years for your score to fully recover. Interest rates. Creditors may view you as a higher risk after bankruptcy, leading to higher interest rates on loans and credit cards for several years, often up to 7 years or more. Employment challenges. Some employers do check credit scores during the hiring process. Bankruptcy can affect job opportunities, particularly in fields such as finance and security, where financial responsibility is crucial. Think about it. If your car breaks down tomorrow, would you be able to get an emergency loan? Following a bankruptcy filing, obtaining such loans becomes significantly more challenging and often comes with higher interest rates due to the negative impact on your credit score. Day-to-day living. How does this translate into everyday life? Subject: impact of bankruptcy on personal finances. Renting a home. Landlords typically require high credit scores and may demand higher security deposits or cautioners from individuals with a history of financial difficulties. Car insurance rates. Higher premiums are common for those with lower credit scores, increasing monthly expenses. Cell phone plans. Some providers may charge more for customers with poor credit, adding to monthly costs. Bankruptcy can be likened to living in a house with leaky windows and drafty doors, where maintaining the property becomes more costly and challenging. Post-bankruptcy, managing personal finances often involves higher interest rates on loans, reduced credit scores, and difficulty obtaining new credit, making financial stability harder to achieve. Impact on savings. Savings take a hit too. Subject: impact of bankruptcy on personal finances. Emergency fund building one becomes more challenging. With higher interest rates, less money may be available for savings each month. Retirement plans. Contributions could decrease as you focus on paying off debts instead of funding your retirement accounts. Imagine trying to fill up a leaky bucket. Every time you add money towards rebuilding your financial health after bankruptcy, some of it seeps out due to high fees and interest charges associated with new debt and credit products. Hidden costs. Beyond direct financial impacts, there are hidden costs. Legal fees. Filing for bankruptcy is not free. Legal fees can range widely depending on the complexity of one's financial situation and the type of bankruptcy filed, Chapter 7 or Chapter 13, typically costing several $1,000s. Counseling requirements. Before filing, individuals must complete credit counseling from a government-approved agency within 6 months prior to filing. This requirement adds additional costs and time commitments. Record keeping. Maintaining detailed records of your financial transactions is crucial throughout the bankruptcy process to substantiate claims and comply with legal requirements, helping to avoid future complications or disputes. Understanding and complying with the post-bankruptcy regulations can be as demanding as maintaining a full-time job, which is essential for restoring financial well-being. Psychological impact. Bankruptcy affects more than just numbers. Emotional impact. The process can be emotionally draining, leading to increased levels of anxiety and depression. Social effects. Some friends or family members might distance themselves, adding social stress on top of existing financial concerns. Think about it. If you were going through this, how would you feel? Bankruptcy can have profound effects on your personal finances, impacting your credit score, ability to obtain loans, and overall financial stability for years to come. It's not just a number, it's your life and future being reshaped in significant ways. Rebuilding strategies. So what can you do to recover from bankruptcy? Credit monitoring. Regularly check your credit report to monitor any changes in your score. Small improvements can make a significant difference over time. Budgeting. Establish strict budgets to effectively manage expenses and save money carefully. Debt management. Avoid taking on new debt by using cash or debit cards for purchases instead of credit. It's like starting a garden after a long, cold winter. The ground may seem lifeless, but with proper care and effort, you can nurture it back to health over time. Real-life examples. Consider real cases. John. After Chapter 7 bankruptcy, John's credit score dropped significantly, but not necessarily to as low as 350 unless there were other negative factors involved. It's more common for scores to drop by about 100 points initially, and then gradually improve over time with responsible financial behavior. 5 years later, it could climb back up to around the mid-600s if John consistently managed new lines of credit responsibly. Sarah. Filing under Chapter 13, Sarah paid off her debts according to a repayment plan that typically lasts 3 to 5 years while keeping her home and car. Her score likely improved gradually each year as she made consistent payments on time and demonstrated financial responsibility. These examples demonstrate that recovery from bankruptcy is possible, but often requires patience and discipline. The bigger picture. Bankruptcy is a legal tool designed to provide financial relief and a fresh start when other debt management strategies have failed. Understanding its potential impacts can help individuals better navigate the process and make informed decisions. Education. Understanding what bankruptcy involves before filing can help avoid costly mistakes. Planning. Developing a long-term financial plan after bankruptcy is crucial for recovery. Bankruptcy can be seen as a temporary setback that allows individuals to regain financial stability and work towards rebuilding their financial health. With the right strategies, people can recover and achieve future success. Final thoughts. Filing for bankruptcy is a significant and complex process with long-term implications. However, it can be the start of regaining control over your financial situation. In short, bankruptcy can be challenging but may be necessary in certain situations. It's important to plan carefully, stay informed, and understand that financial recovery is possible with time and effort. This is educational and historical, not financial advice. Let's delve deeper into how bankruptcy impacts various aspects of personal finances and explore the steps one might consider to begin recovery. Firstly, one of the biggest impacts of bankruptcy is on your credit score. When you file, it shows up on your credit report immediately, potentially dropping your score by 75 points or more. This makes it harder to secure loans, credit cards, or even rent an apartment for several years. However, after a few months, as you start rebuilding your financial habits and paying bills on time, your score will slowly begin to recover. Another aspect is the impact on your assets. Bankruptcy can protect certain essentials like your home and car through exemptions set by state laws. For instance, if you own a primary residence, many states allow you to keep it up to a certain value during bankruptcy proceedings. However, it's crucial to know that any non-exempt assets might be liquidated to pay off creditors. Let's talk about the process itself. Filing for Chapter 7 bankruptcy involves listing all your debts and assets in detailed documents provided by the court. This can be overwhelming, but is necessary to ensure a fair distribution of what you have among those you owe money to. On the other hand, Chapter 13 allows you to set up a repayment plan over 3 to 5 years, which might be more manageable if you want to keep your assets and continue meeting financial obligations. Here's an example. Imagine you're struggling with credit card debts and medical bills totaling $50,000. Filing for Chapter 7 could wipe out most of these unsecured debts, but it would also mean liquidating any non-exempt property to repay creditors. Alternatively, a Chapter 13 plan might require you to pay back a portion over the course of 3 to 5 years, rather than specifying $2,000 per month for exactly 3 years, while allowing you to keep your house and car. It's important to understand that bankruptcy isn't a quick fix. It's part of a process that involves several steps and regulations. After filing, you must complete credit counseling before filing and receive education on budgeting and financial management post-filing. Adhering to court-mandated guidelines is crucial for regaining stability and improving your financial health over time. One key strategy in recovery is building an emergency fund. Start small, perhaps aiming to save $1,000 initially, and gradually increase it as your finances stabilize. Having even a modest buffer can prevent future emergencies from derailing you financially. Another critical step is managing new credit responsibly. Once your bankruptcy discharge is final, creditors may begin extending offers again, but proceed with caution. Avoid accumulating new debt and focus on rebuilding your credit score by consistently making timely payments and maintaining low account balances. Rebuilding relationships with financial institutions might also take time. After a bankruptcy, banks may initially deny you loans or credit cards, but as your financial situation improves and your credit score begins to recover over several years, they'll likely become more willing to work with you again. Lastly, consider seeking help from a professional credit counselor or financial advisor who can provide educational guidance and support throughout this challenging period. They can offer strategies tailored to your specific situation, helping you better understand and manage the complexities of post-bankruptcy life. In summary, while bankruptcy is tough on personal finances in the short term, it provides an opportunity to start fresh and build a stronger financial foundation moving forward. With patience, discipline, and informed decision-making, recovery is achievable. This is educational and historical, not financial advice. Bankruptcy can also affect your job prospects, especially if you're applying for positions that require background checks or involve handling money. Some employers might view bankruptcy as a red flag, but it's important to note that many companies prioritize an applicant's skills and qualifications over their credit history. Another often overlooked aspect is how bankruptcy affects your relationships with family and friends. Financial troubles can strain personal connections, potentially leading to increased tension and the risk of losing support networks. It's important to communicate openly about your situation and seek understanding from those closest to you. Additionally, consider the emotional toll that bankruptcy can take. The stress and anxiety associated with financial difficulties are real and can have significant impacts on mental health. Seeking professional help from a therapist or counselor who specializes in financial distress can provide valuable support during this challenging time. In terms of long-term financial planning, establishing an emergency fund is crucial once you have emerged from bankruptcy. This fund serves as a safety net for unexpected expenses, reducing the likelihood of falling back into debt. Aim to save at least 3 to 6 months' worth of living expenses in a readily accessible account. Lastly, keeping detailed records and staying informed about changes in your credit report can empower you during recovery. Regularly checking your credit score and understanding how various financial actions impact it helps you regain control over your finances. This proactive approach sets the stage for rebuilding trust with lenders and improving your overall financial health over time. This information is educational, not financial advice.